Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Please join me today in welcoming back Amitabh Bhargava to the program. As a refresher for those of you who have missed his prior appearances on the podcast, Amitabh brings 2 decades of experience helping create value for wholesale and consumer lending businesses. He helps SRA consulting clients set up, assess, and refine best practice credit risk strategy, risk governance, portfolio risk mitigation tools, and climate risk and sustainability strategy. Before Amitabh was part of SRA Consulting, he spent 18 years at Capital One and most recently oversaw the credit analytics and research programs for the wholesale portfolio there at Capital One. Prior to Capital One, Amitabh supervised executive credit risk assessment for Capital One's wholesale and retail portfolios, and Amitabh is an accredited RMA CRC certified professional, a GAP certified FRM and SCR professional, a CFA charter holder, and a board member of the RMA in Richmond. Amitabh, it is great to have you back with us today. Thank you for being here.
Thanks, Ed.
Amitabh, it's been about a year since you joined us to discuss the trends in the U.S. ag sector and their impact on agricultural lending risks. So I'm excited to explore a similar topic today, right? Informed by the economic data that recently was released by the U.S. Department of Agriculture's Economic Research Service in their 2024 farm sector income forecast earlier in September. You've taken a look at this data, and so we're going to break this conversation really, I think, into 2 parts. And you're going to help us interpret this data and then understand the risk management implications for those who are involved in this space. So in our first episode here today, we'll start by understanding really the current state of the U.S. agricultural sector. We'll dig into the observations you make in the report. And then in our second episode, we'll come back and really get into some of the data and how did you present it in terms of your dashboards and your white paper. And we'll talk a little bit about the non-credit related risk implications that have come out of the report as well. So with that being said, let's start with this first question, really of understanding the current state of the U.S. agricultural sector. We're coming off a period of record highs a few years ago. And now there's been a bit of movement back from that. So can you give us a brief overview of the current landscape and how it's changed over the last year or so since your last white paper was released?
Yeah, absolutely, Ed, and great to be back. Ag sector has a lot of unique items in it, and as we discussed, last year when we did about 12 months back a similar program, it ebbs whatever and wanes in a slightly different way than rest of US economy. So for instance, pre-COVID, it was already struggling, and post-COVID, it had one of the best times in 21 and 22. Now, it was a lot of good thing back in 22, so it had to moderate. And as we discussed last time around, it did the net cash farm income, which is the total, macroeconomy based, US based farm income. It declined substantially, nearly by 29% in 23. And it's projected to again decrease about 9 to 10% in 24. So it's a somewhat deceleration of that decline, but there is a sustained decline of that net farm income. And obviously, if that happens, that creates financial stress for the farmers, right? Now, what can banks do? Obviously, if there is a projected decline in farm income and the input costs, even though the rise in input costs is moderating, it's still, increased substantially. So that reduces farmers' ability to service loans and increases the risk of defaults. Interestingly enough, the overall credit risk metrics are still fairly good. So the whole point is it is something which is more like one has to be cautious about it. And banks should also anticipate some higher demand for refinancing or loan restructurings if farmers are going to struggle with cash flow challenges. The other thing I would add is in terms of there is lower income, but what is causing lower income? Those drivers of lower income are slightly different this year versus last year. So last year, the key drivers were lower government payments because a lot of subsidies and support programs instituted in wake of COVID, they were slowly, declining.
Right.
And production expenses were rising because the inflation was substantial in 23. Now, as I said, overall inflation is moderating. But this year, the issue more has been the prices, the commodity prices for crops like corn and soybean. So the farmers who are focused on crop sectors, they are somewhat struggling with lower prices out there. It's a bit of tale of two cities though, because there are farmers who focus on livestock sector or poultry, and both eggs, cattle, dairy, there the prices have been stable to higher this year. So it's again, if I'm a lender, I obviously it helps if I have a diversified portfolio, and the tighter margins for crop farmers in particular may create, weaker repayment capacity and more credit risk, whereas livestock farmers may be doing better in that concept.
One of the things, Amitabh, before you leave that, because
Sure.
you're talking about really the inputs here as well. I know that there's one of the other inputs is labor costs, right, and how that factors into this as well, and especially right when you think about, and we've talked about this previously, where farms have invested heavily in technology, right, and perhaps have less of a dependency on labor costs. So there's an interesting kind of play there between that investment in technology and capital equipment versus people.
Oh, absolutely. And one of the things though is that in order to invest in technology, you require capital, and
Right.
when interest rates are high, that itself is a little bit challenging. What has helped though is that the production expenses have been somewhat moderate, or they've declined, or rather they've not increased at the same pace as they did earlier in 23. And what has helped is things like fuel prices or feed and fertilizer prices. They have, been moderate. So that's helpful. But from a bank viewpoint, we need to look at our borrowers' operational efficiencies and cost management practices. What do they have in place so that they're not just reliant on, government payments per se.
Right. Right. Yes. Absolutely. You talked there about you talked about borrowing to the extent that a farm wants to make a capital investment, whether it's in technology or innovation, to try and improve that operating efficiency. But there's obviously a cost of borrowing in a high interest rate environment that we've been in, right? That's a challenge.
Right.
But I think that one of the things I imagine that a lender is going to look at is the value of property, and right the value of all of the assets, if you will, right, the balance sheet there of the farm, and then how stable that is as a driver for are we willing to lend here? So can you talk a little bit about the dynamics around the balance sheets there, perhaps, of the farmers?
Absolutely. So in terms of income statement, as we said, overall the profitability is somewhat strained this year. but the balance sheets are still fairly strong. And they are fairly strong because farmers have essentially have had those good years in 21, 22. And what has also helped is, as you said, the farmland values. Overall real estate sector across the board, except for obviously commercial real estate, has been on a tear, right? So the farmland values, they continue rising in kind of high single digits. Although, as one would imagine, real estate is always local. So it's somewhat different. In Texas, for instance, the land prices are still rising substantially, whereas in some of the other areas, the farmland values are rising only by 2 or 3% after having risen almost in double digits earlier. So those high land values, farmland values help in terms of boosting the overall balance sheet and solvency. But at the same time, one has to be cautious because that pace of increase has slowed down. And yeah, so the banks have to be somewhat cautious about monitoring it, absolutely by locality or by geography. Or what are the drivers out there?
Got it. Because right, that the debt service burden can very quickly get out of whack if those real estate values do quickly moderate or start to fall, and then all of a sudden you've still got these high debt service costs on there, and your balance sheet is shrinking, and because as you said, maybe it's a local dynamic there, and so
Right.
I think your point there of the kind of the macro or the global, but then also the local is a really important distinction.
And it does, I would say, it happens to us when our home values are, declining. It impacts our sentiment, consumer sentiment in general, and, the ability to buy things and all. And it's the same concept out there. So if you look at the farmers' sentiment, and these are some surveys which are conducted by Federal Reserve, by Purdue, University of Purdue, and so on. And if we look at them, the farmer sentiment, that's become quite cautious. Even last year, producers or farmers had responded to those surveys saying that they were expecting economic challenges due to rising input costs, declining prices, and all. But that sentiment has worsened substantially now. And those indices, they show that there's something called Farm Capital Investment Index, which really is saying like how much capital expenditure they want to do. And that's hit record lows. So that obviously will translate into demand for loans from banks, because now banks, the farmers may need funds to run their operations if they are not making enough profits, but they won't be investing in capital equipment as much. So yeah, that piece about farmer sentiment having deteriorated is also worth noticing.
One other topic that we haven't really touched on here is the broader macroeconomic environment and the import-export question as well. So perhaps you could share a few thoughts on that dimension.
Well, absolutely. US exports a lot of ag products, and out there the dynamics which is there is what is the trade policy, what are the regulations which we are having, as well as our exchange rates, how strong US dollar is versus other currencies that we care about, maybe Brazilian real in particular, or how's our trade relations with China and so on. And out there, things have been somewhat tough for ag sector because US dollar has been strengthening. It's strengthened substantially over the last few years. And what that does is our products, when we try to sell to consumers abroad, they are far more expensive in their local currencies. Whereas when we are importing things, the products that we want to import, they are relatively cheaper in our US dollar. So that trade balance in ag sector that's been, running somewhat adverse, and more so from last year to this year. One other item is, what is it that we export and what is it that we import? So what we are importing is a lot of horticultural items, vegetables, kind of stuff. And the demand growth due to consumer preference is somewhat higher for those items versus us exporting soy, which is really for animal feed and so on. So the egg trade sector is also somewhat where our exports are slowing down and imports are growing substantially.
It's a really interesting point around the economics of it, but also how the personal preferences and cultural shifts have that significant of a downstream impact on the economics themselves.
Right.
Amitabh, we've covered a lot of ground here. I know there's one area we haven't touched, and maybe I'm going to actually save that for our next conversation, because we didn't talk significantly about climate change and how that kind of fits into the picture. I know that's an area where you have a lot of depth of knowledge as well. But I think that we've done a nice job of introducing, I'll say, the trends or the themes from the white paper. So unless there's anything else you want to mention at that level, I would say we'll wrap this session. We'll invite folks to jump on the Risk Intel website, grab the white paper if they'd like to read that, connect to you on LinkedIn as well. Hopefully this has gotten some people thinking about some of these topics around optimization and diversification and exposure, and the impact that it's going to have on these financial institutions. I know you'd be willing to talk to anyone who would like to dig into that with you. So encourage folks to grab you directly or to grab the white paper as a resource. And we'll come back in our next segment and talk a bit more about dissecting the data, which you have in the report, how to read that, what does that tell us, and then evolve into some of the non-credit risks and how those should be monitored.
Yeah,
thanks,
absolutely.
Amitabh.
We are just transitioning from, it's somewhat like an inflection point from strong profitability to increase financial stress. So it's interesting times. Thank you, Ed.
Thanks, Amitabh.
Yeah.